Look at that transaction. You tapped your card, heard a tiny beep, and walked away with $100 worth of groceries. The whole thing took less than a second. No counting bills, no waiting for change, no feeling money physically leave your hand. It felt frictionless, but before that $100 reached the store, a small portion of the transaction had already been claimed by the payment system. Not as a government tax, not as a sales tax, printed clearly on your receipt, but as a private toll built into the digital road your money had to travel. Depending on the card, the merchant, and the payment provider, the total cost of accepting a credit card can reach roughly 3% of the purchase. On a $100 transaction, that can mean close to $3. You do not see it. The cashier may not explain it, but somewhere inside, the price you paid, the cost of accepting your card, is waiting. And once you understand how that cost works, cashback rewards, premium cards, and even cash discounts begin to look very different. This is the hidden machinery behind every card swipe. Card payments were not originally designed as a trap. They solved a real problem. Imagine walking into a store decades ago without enough cash. The merchant does not know you. There is no digital banking app, no instant transfer, and no easy way for the merchant to know whether you will return and pay. A bank steps between you and the store. The bank tells the merchant, "I will approve this customer, I will help move the payment, and I will take responsibility for part of the risk." In exchange, the bank and the companies operating the payment system take a small cut. Part of that cost is called the interchange fee. Other parts can include network assessments, processing charges, payment gateway costs, and the merchant's agreement with its payment provider. That distinction matters. It is not accurate to say that every card swipe carries one universal 3% interchange fee. Different cards create different costs. Debit cards can be cheaper. Basic credit cards may cost less than premium rewards cards. Small merchants may also pay more than large retailers that can negotiate better contracts. But the total cost of accepting a credit card commonly falls somewhere between roughly 1.5% and 3%. Sometimes it can be even higher. At first, this sounds like an ordinary business expense. A store also pays for electricity, security, employees, rent, and delivery. So why should card fees bother you? Because businesses do not create money to cover expenses. They recover those expenses through prices. If nearly everyone pays with the card, the merchant cannot realistically treat card acceptance as an occasional cost. It becomes part of the cost of selling almost everything. His store may raise prices across the board. That means the fee is not necessarily charged to you as a separate line on your receipt. Instead, it can become part of the price of groceries, clothing, fuel, restaurant meals, and everyday services. Even a customer paying with cash may face a price shaped partly by the cost of card payments. This is where the system becomes uncomfortable. A premium card may offer airport access, travel points, insurance, or 2% cashback. Those benefits feel free, but they are not free. Someone funds them. A portion can come from annual fees or interest paid by cardholders. A portion can also be supported by the revenue banks receive when customers use their cards. The more valuable the reward program, the more incentive the bank has to place that card at the top of your wallet. The bank gives you points. You become loyal to the card. You use it more frequently. The bank collects more transaction revenue. It is a remarkably effective loop. But the merchant is placed in a difficult position. Card networks have historically used rules commonly described as honor all cards. In simple terms, a merchant that accepts a network's cards may have limited ability to reject one expensive card while accepting a cheaper card carrying the same network brand. Imagine that you own a small grocery store. A customer offers a basic card with relatively low acceptance costs. You accept it. The next customer presents a premium rewards card that costs you more. You may not be able to separate those cards as easily as you would separate two completely different payment systems. From the consumer's perspective, both cards simply say Visa or MasterCard. From the merchant's perspective, they may not cost the same. That creates a strange market. The person choosing the expensive payment method does not directly negotiate the fee. The merchant paying the fee did not choose the customer's card, and the customer is encouraged to select the card offering the largest personal reward. Bank can therefore compete for wealthy customers by offering better rewards, while part of the cost passes through the merchant and can eventually influence retail prices. This is why cashback is not simply money created by generosity. Suppose you buy something for $100 and receive $2 in cashback. You feel as if you defeated the system. But if payment costs have already contributed to higher prices across the economy, your $2 reward may represent only a partial return of costs hidden elsewhere. And not everyone receives the same return. A customer with excellent credit may qualify for a premium rewards card. A lower income customer may pay with cash, debit, or a basic card offering no reward. If both customers face the same inflated shelf price, but only one receives premium benefits, the system can transfer value toward the person holding the better card. The result is a quiet redistribution. People with access to the best rewards can recover some of the cost. People without those rewards may still help support a pricing system influenced by card fees, but transaction fees are only half of the story. The other half happens inside your mind. Paying with cash creates a clear moment of separation. You open your wallet, you count the bills, you hand them to another person. You see that your wallet contains less money than it did a few seconds earlier. A card changes that experience. You tap a piece of plastic. The card returns to your hand. Nothing visible appears to disappear. Your bank balance changes somewhere else, often hours or days later. Researchers have spent years studying how payment methods affect spending. The safe conclusion is not that every person automatically spends exactly 15% more whenever a card is used. Human behavior is not that predictable. But research does show that credit cards can increase the motivation to buy. MIT researchers found that credit cards can activate reward networks in the brain. The card does not merely remove friction. It can become associated with the anticipation and pleasure of purchasing. That is an important distinction. The card may not only release the brakes, it can also press the accelerator. Older studies have also found that consumers can be willing to pay more when using credit instead of cash. The precise increase varies by study, person, product, and situation. So claims that every card purchase produces a guaranteed 12, 15, or 18% increase should be treated carefully. The real danger is more subtle. When payment becomes less noticeable, adding one more item feels easier, upgrading feels easier, accepting a subscription feels easier, and spending tomorrow's income feels almost identical to spending money you already have. Now, compare that behavioral effect with the cashback reward. A 2% reward on a $100 purchase gives you $2. But if the convenience and reward system persuades you to buy something unnecessary for $15, the cashback did not save you. It helped make the larger purchase feel intelligent. You did not win $2. You spent $13 more than you intended. That does not mean credit cards are always bad. A disciplined user who pays the balance in full, avoids unnecessary purchases, tracks every transaction, and uses strong consumer protections can benefit from a card. The problem begins when rewards are used to justify spending. A discount saves money only when you are already going to make the purchase. Cashback does not turn unnecessary spending into profit. And points have no value until they are redeemed for something you genuinely need. You can see the hidden card cost most clearly at some gas stations, restaurants, and small businesses. A sign may advertise one price for cash and a higher price for credit. The lower number is described as a cash discount. Sometimes it truly is structured as a discount, but economically, the difference often reveals something important. The card price includes a payment cost that the merchant does not face in the same way with cash. The language changes how you feel about it. Cash discount makes the lower price sound like a gift. Credit surcharge makes the higher price sound like a penalty. The numbers can be identical, only the story changes. For years, network rules and laws limited how freely merchants could steer customers toward cheaper payment methods. Those rules have faced legal and regulatory challenges, and merchant options now vary by location and contract. But the history matters because hiding price differences weakens competition. If customers cannot see that one payment method costs more than another, they have little reason to choose the cheaper system. And if merchants cannot clearly communicate the difference, networks face less pressure to reduce their fees. Other countries have made different choices. In the European Union, interchange fees on many consumer credit card transactions are capped at 0.3%. Consumer debit card interchange is generally capped at 0.2%. The United States does not apply the same general cap to credit card interchange. That does not mean every European merchant pays only 0.3% in total. Interchange is only one component of card acceptance. Processing, network, and service costs can still exist. But limiting interchange changes how much revenue is available to fund an escalating rewards competition. The difference also demonstrates something important. A payment fee is not a law of nature. It is the result of contracts, regulation, competition, technology, and bargaining power. The United States did intervene in debit card fees through the Durbin Amendment. The rule applied mainly to regulated debit card issuers above a defined asset threshold. It did not create an equivalent nationwide cap for credit cards. That is why saying the government capped card fees would be misleading. It capped certain debit interchange fees under specific conditions, while the larger credit card reward system continued operating differently. Banks strongly oppose the change because transaction fees are a major source of revenue. Supporters argued that lower debit fees would reduce costs for merchants and encourage competition. Critics argued that banks would recover lost revenue through other charges and that consumers would not necessarily receive lower retail prices. Both sides reveal the same reality. Payment systems are never free. If revenue disappears in one place, companies often search for another place to recover it. So what should you actually do? You do not need to destroy your credit cards or carry an envelope of cash everywhere. You need to remove the illusion. First, treat the card like cash that leaves your account immediately. After every purchase, imagine the same amount physically disappearing from your wallet. Second, ignore rewards when deciding whether to buy. Make the buying decision first. Choose the payment method. Second, third, pay the full statement balance on time whenever possible. A single month of high interest can erase a long period of cashback rewards. Fourth, compare the cash and card prices when a merchant offers both. A 2% reward cannot compensate for a 3% surcharge. Fifth, track total spending, not points earned. A rewards dashboard celebrates what the bank wants you to notice. Your monthly spending total shows what actually happened. Finally, remember the original $100 grocery transaction. You tapped your card because it was fast. You trusted that the displayed price was the real price. You assumed the rewards were a gift. But underneath that single beep was an entire financial machine. The merchant paid to enter it. The bank earned from operating inside it. The network controlled the road. And you were encouraged to travel that road as often as possible. Convenience is valuable. Consumer protection is valuable. Credit can be useful. But none of them is free. The system becomes powerful when its price is invisible. Now you can see it. The next time the terminal asks you to swipe, insert, or tap, remember, the transaction may feel frictionless. The cost is not.